For most of your working life, investing was pretty straightforward. You contributed to your 401k every paycheck, you watched your balance grow, and when the market dropped, it was painful, but you weren't selling. You were actually buying more shares at lower prices. So time was on your side. But the moment you retire, everything seems to change. You're not adding money, you're taking it. Market drops aren't theoretical anymore, they directly affect your ability to fund your lifestyle. And time isn't on your side the way it used to be. So this is why retirement investing is fundamentally different from accumulation investing. The goals are different, the risks are different, and the strategies need to be different. So today we're talking about good investing for retirement. What changes, what stays the same, and how to think about building a portfolio that can actually last 30 years. When you're working and saving, the advice is simple. Contribute consistently. Buy low and sell high. Stay invested for the long haul. Don't panic when the markets drop. And that advice works because you have three huge advantages. Advantage one is time. You've got 20, 30, or maybe 40 years until you need to do anything with this money. If the market crashes, you can wait it out. Advantage number two is that you have fresh contributions going in every paycheck. Dollar cost averaging works in your favor in this situation. And advantage number three is you've got no distributions. You're not taking money out. So your portfolio doesn't have to produce income. It just has to grow over time. But in retirement, you lose all three of these advantages. Your timeline shrinks. You might have 30 years ahead of you, but you need money from this portfolio next month, next year, and every year after that. You can't just wait out a 10-year bear market and not take any income. So you're not adding money, you're taking it. No more paychecks are going in. Now it's distributions coming out every month or every quarter. Whether the market is up or down, by the way. Your portfolio has to produce. It's not just about growth anymore. It has to support your lifestyle, keep pace with inflation, and last as long as you do. This is why the standard accumulation advice, stay fully invested in stocks, ride out volatility, focus on maximizing returns, doesn't always translate well to retirement. So you need a different approach, one that's built for durability, not just for growth. But before we talk about solutions, let's talk about the specific risks you're managing in retirement. Because if you don't understand the risks, you can't build a strategy to address them. So risk number one is sequence of returns risk. The order in which you experience market returns matters enormously when you're taking distributions. If you retire and the market crashes in year 1 or 2, and you're forced to sell shares at depressed prices to fund your lifestyle, well, when the market eventually recovers, you have fewer shares left to participate in that recovery. Your portfolio never fully catches up. So two people with identical portfolios and identical withdrawal rates can have completely different outcomes based purely on the timing of market returns early in their retirement. That's sequence risk, and it's one of the biggest dangers you face. Now, risk number two is longevity risk. You might live 20 years in retirement, or you might live 35. You don't know. And if you plan for 20 years and you live 35, you run out of money. If you plan too conservatively, trying to make it last 40 years, you might be in a place where you don't have enough growth to keep pace with inflation, and you end up depleting your portfolio anyway. Longevity risk is the uncertainty of not knowing how long your money needs to last. And the hard part is, it is completely unknowable. Risk number three is inflation risk. Even modest inflation, 3% per year, cuts your purchasing power in half over 24 years. Healthcare inflation is often even higher, several times higher. So if your portfolio isn't growing enough to keep pace with inflation, well, you're slowly running out of money, even if your account balance looks fine. And risk number four is behavioral risk. This is the risk that you panic and sell at the bottom, or the risk that you chase performance and buy high, or the risk that you abandon your plan completely because the market's doing something scary or exciting for that matter. And historically, the biggest risk to long-term investment success hasn't been market crashes. It's been investor behavior. Buying high, selling low, changing strategies at exactly the wrong time. These are the risks retirement investing has to address. Not hypothetical risks, real risks that derail real retirement plans. So how do you build a strategy that addresses these risks? It comes down to three core concepts. Diversification is part one. Diversification is about owning different types of stocks that don't all move together. So most people think diversification means owning a bunch of different funds. But if all those funds invest in large US companies, you're not diversified, you're concentrated. Real diversification means owning exposure across large cap, small cap, US, international, emerging markets, value, growth, different equity categories that respond differently to economic conditions. And why? Because you can't predict which area of the market will perform best in any given year. The winner changes constantly. If you're concentrated in one area and that area has a bad decade, well, you're in trouble. Diversification isn't about maximizing returns. It's about reducing the risk that one bad bet derails your entire plan. But the key idea is different types of stocks, not just a few different funds. Part two is asset allocation. Asset allocation is about managing short-term distribution risk. So here's the traditional advice, and you've probably heard it. As you get older, shift from stocks to bonds. By retirement, you should be 60-40 or maybe 50-50 stocks to bonds. The problem with that approach is it sacrifices the growth you need over 30 years while still exposing you to volatility when you need distributions. And there's a better way. You separate your portfolio into two parts. You keep 5 to 6 years of spending needs in stable, liquid assets, so cash, money markets, short-term bonds. This is what we would call at Five Stone your income reserve. This is what you spend from when the markets are down. Everything else stays invested in a diversified equity portfolio for long-term growth. Now, when the market crashes, you're covered. You're not selling stocks at a loss, you're spending from the reserve. Your equity portfolio can drop 40%. And not that it doesn't matter, but you've got 5 years of 5-year cushion to help cushion the blow. So historically, even the worst market crashes have recovered within a few years. And while past performance doesn't guarantee what the future holds, 5 years of stable assets has historically been enough time to ride out those downturns without being forced to sell. This approach lets you maintain that equity exposure for growth and your long-term picture while managing the specific risk of needing money when the markets are down. That's asset allocation for retirement, not stocks versus bonds as a rule of thumb, but a deliberate strategy to maintain distribution risk. Part three is asset location. Asset location is about tax efficiency, and it's the strategy most people miss. So here's the concept. You've got different types of accounts. You've got traditional IRAs, Roth IRAs, taxable brokerage accounts, and each one is taxed differently. Traditional IRAs, everything that comes out is taxed as ordinary income. With Roth IRAs, everything that comes out is tax-free. And with taxable accounts, your capital gains and dividends are taxed at lower rates than ordinary income. If you're holding the wrong investments in the wrong accounts, you could be paying tens of thousands of dollars in unnecessary taxes over your retirement. The basic framework is bonds and income producing investments, so things that kick off income on a regular basis, go in tax deferred accounts. Your highest growth related stocks or ETFs go in Roth accounts where that growth compounds tax free. Tax efficient stock index funds can sit in taxable accounts. Same portfolio, same allocation, but potentially massive tax savings just by putting the right investments in the right place. But the point is, where you hold your investments matters just as much as what you invest in. These three concepts, diversification, asset allocation, asset location, they all work together, and you need all three. Here's the mindset shift you need to make in retirement. When you're accumulating, the goal is growth. You're trying to maximize returns over time. You want your portfolio to compound as much as possible, but in retirement, the goal is durability. You need a portfolio that can support your lifestyle for 30 years or more, that can keep pace with and hopefully exceed inflation, that can survive multiple market downturns without forcing you to sell at the bottom. And it needs to adapt to changing needs. healthcare costs, family circumstances, unexpected expenses, and ideally to leave something behind for the people or causes that you care about. That's durability. It requires a different approach than just maximizing returns. Reliable beats exciting when you're living off this money. Because in retirement, volatility isn't just emotional discomfort, it's real risk to your plan if it's not accounted for. So, this is why good retirement investing isn't about being clever or chasing performance. It's about building a plan that works in multiple scenarios: bull markets, bear markets, high inflation, low inflation, long life, short life. You're not trying to maximize one outcome, you're trying to increase the probability that your plan works no matter what happens. Because you know what? The future is unpredictable. So before we wrap up, let me address a few common misconceptions about retirement investing. Misconception number one is that I need to get super conservative in retirement. Well, that depends on what you mean by conservative. If conservative means moving 70% of your portfolio to bonds and cash, you might be creating a different problem. You may not have enough growth to last 30 years. Conservative in retirement should mean manage your short-term risk so you can stay invested for the long term. That's what the income reserve does in that situation. It's not about avoiding equities, it's about protecting your equity allocation with a buffer strategy. Now, misconception number two is I can't afford to lose any money in retirement. Well, here's the thing, you're going to experience losses because markets go down sometimes, significantly. That's unavoidable. The question is, will you be forced to lock in those losses by selling at the worst possible time? That's what you're protecting against. Not volatility itself, but the consequence of volatility when you need distributions. The third misconception is I need to time the markets or make big moves to protect myself. No, the opposite. The strategy that works in retirement is boring and disciplined. Stay diversified across equity types. Maintain your reserves. Don't sell when things are scary. Refill the reserves when things are good. That's it. Trying to time the market, getting out before crashes, getting back in before rallies, it just doesn't work. What works is having a plan that can handle multiple scenarios and sticking to it. And the fourth misconception is if I just pick the right funds, I'll be fine. Fund selection matters, okay? But it's not the most important thing. Getting your diversification right matters more. Getting your asset allocation right matters more. Getting your asset location right matters more. Most people spend 90% of their time trying to pick funds and 10% of the time thinking about strategy. It should really be the other way around. So here's the bottom line. Retirement investing is about managing risks you didn't have to worry about when you were accumulating. Sequence of returns risk, longevity risk, inflation risk, behavioral risk. The solution isn't to avoid the market or get ultra conservative. The solution is to build a portfolio with three components working together. Diversification across different types of stocks, so you're not dependent on one area of the market working out. Asset allocation that manages the short-term risk with an income reserve, so you can stay invested in equities for that long-term growth. And asset location that optimizes for taxes, so you keep more of what you earn. None of these concepts are actually that complicated, and none require special knowledge or insider information. They just require discipline and a plan. This is what good retirement investing looks like. Not exciting, just a strategy built to last 30 years through good markets and bad. Over the next few weeks, we're going to do deep dives on each of these three concepts. We'll talk about what real diversification looks like, how the income reserve strategy actually works in practice, and how to think about asset location to minimize your tax bill. If you're approaching retirement or already there, these videos will help you think clearly about how to build a portfolio that can support you for the long haul. Subscribe so you don't miss them, and if you have questions or topics you'd like us to cover, drop them in the comments. Thanks for watching, and I'll see you on the next video.